Hi, I'm Brien Lundin, and I'm at the Metals Investor Forum here in sunny, snowy Toronto, right ahead of the big annual PDAC conference. I have the great pleasure to be talking with David Rhodes, who is the chairman of Empress Royalty and Streaming. And David, I guess have a long and distinguished career in the mining industry, and you have set up Empress with your partners to take advantage of or to focus on gold and silver. Obviously, there's more to that, but I mean, there's a macro story there that you're interested in, and you want to leverage gold and silver. But also, there is a niche that Empress is not your run-of-the-mill royalty and streaming company. Can you explain to our audience what you do, and then we'll get into why you're doing it?
Sure. So thank you for that. The key driver behind setting up the company, and it was 5 years ago, we saw the fact that the large streaming and royalty companies were getting bigger and bigger. Their ticket sizes were moving from 50 to 100 million. And that left a huge hole in the marketplace for the smaller streaming companies. And another part of my job is working for Endeavour Financial, one of the largest advisory boutiques. And we put financings together, but we could not find the small streaming companies to fill that hole. And that's why we set up Empress. So we are looking at small $20 million, sub $20 million ticket size streams and royalties to fund those smaller companies.
So you're looking to finance for clients and consultant financing packages, and you couldn't find a way to do that. So might as well create the vehicle.
Correct.
Yeah.
And there's a few other people who've actually joined and undertaken a similar type of company, so some competitors. But the key differential for Empress is the fact that we create royalties. We don't buy them from other people, we create them. So very much, as you said, Brien, financing solutions for the junior mid-tier sector. Those guys that have trouble raising equity, because obviously dilution's a factor, and the market's not always that favorable for the juniors. Debt guys take a long time. They're quite stringent upon their due diligence and also from their covenants. And they're looking more short-term paybacks, while those stream and the royalties are long-term payback mechanism. This is more akin to a long-term mining asset.
Yeah, and I've noticed some of your assets, your royalties, are with private companies that are in areas where they really would be constrained by debt and don't have the access to the public markets. So it really fits that. And again, you are able to custom fit these packages. Long term, any deal that's not a win-win deal is at a disadvantage to somebody. So if companies that are going out there and buying existing royalties that aren't attached in any way to the company, they can't really negotiate that. They don't get data. They don't have opportunities that are presented to somebody that's working closely hand in hand with the company, I would think.
Yeah.
But gold and silver. Now, this is what interests me as somebody who is obviously owns and writes something called Gold Newsletter. So what's the story there? Why are you focused purely on gold and silver?
Well, two factors. I mean, I've been in this business over 25 years, and there's always been magic about gold and silver.
Yeah.
Always been magic. You always get better multiples in the gold and silver market compared to base metals. So you've got a natural edge. If you're an investor in the gold and silver space, as well as obviously being a company, you get a better rating from the investor base. So that's obviously number one. Secondly is the fact that gold and silver, they are, and always have been, good value plays. And if you look at where the world's going and the $1 trillion of debt, all that cheap money, that's got to be paid back, and that's going to be painful. And that's where people look for another asset class, and that's always been gold and silver, in my mind, as a good asset class.
Yeah, I look at the macro picture right now, and I don't know that the fundamentals have ever been more bullish outside of, say, the 1970s for the metals. Now, we were actually discussing at a dinner last night the debt situation. I think that's a real constraint on the Fed, and they're going to have to pause at some point because the debt service costs are starting to soar over $1 trillion a year. You disagree with that a little bit, and I think
only because of inflation.
Yeah,
and inflation is a silent killer.
Right,
and we're not used
Absolutely.
to inflation. People aren't used to it. We've been had a lovely period of low inflation, lots of money. Everything's been relatively cheap, coming from obviously China with obviously their production of cheap goods, and we've been feeding on that nicely, and that's obviously what's caused the inflation. But to stop inflation, you've got to increase interest rates. You've got to shut off demand.
You have to kill the economy.
You've got to kill the economy,
right?
And what's that going to happen? If you kill the economy, you're not getting the tax revenues in. You're not getting the dollars in to pay your debt back. So you come to the position where they've got to beat inflation. I was reading this is an interesting read, the IMF monthly thing, and they were saying, okay, number one, for the IMF is tame inflation.
Yeah.
And you look at the only way to tame inflation, as you say, is interest rates, cut off the money supply, reduce demand, but that's not happening. It's not happening. Jobs, people. You can't find people to do jobs.
Yeah.
So you've got to pay people more. That's just a wage inflator that you can't turn back.
Yeah, so, and it's interesting, that dynamic as well. People are talking about how there can't be inflation at this tight of a job market. And my counter to that has been, unlike previous recessions that we're going to have, this one will be characterized not by a lack of jobs, but by a lack of employees. Yeah. And either way, the economy is throttled because there's nobody out there producing anything.
Yeah.
And so we are living in an interesting time, but I think it's fundamentally different than, say, the last time that we killed off inflation, or Volcker killed off inflation in the 1970s. He was able to raise rates, to 15, 16, 17% to kill off inflation, because at that point, the federal debt was only about 35% of GDP, and now it's closer to 125% of GDP.
Yeah.
So
but that's where you're right. If you look back at the history, which everybody does, look back at how do you beat inflation?
Yeah.
You've got to raise rates higher than the inflation rate.
Yeah,
that's what historically is what you have to do.
Real rates.
So guess where we're going now? We're going 9% rates. Well, we can't do that. The Fed cannot do that.
Yeah.
So how are we going to tame inflation?
Right.
And that's tough.
That's the conundrum. People ask me, well, what should Powell do on various podcasts and interviews? And my answer has been consistently, I think he should run. He should pack his bags, head for a cabin in the woods, and just get the hell out.
True.
Because they really are trapped. And we can sit here and typically pundits do this all the time. They try and plot the path ahead. Well, this is going to happen. They can't do that. And there's just too many unknowns. You can't do that.
Then obviously interest rates mean a strong dollar.
Yeah.
A strong dollar, obviously not good for the, producing, companies in the US. It's not going to be positive on their, on their production. So.
Yeah, but then again, the other countries are doing the same thing.
Yeah.
The trade partners of the U.S., the other components that go into the dollar index, they're in the same position. They have debts that are too high. Mm-hmm. They are trying to kill off inflation. So my mind is, over the longer term, the dollar index and the like are just measuring who's temporarily at the head of the race to the bottom of the hill. Yeah. But the short term, it's, the Fed is absolutely trapped. They don't have the tools. So I guess what I'm saying generally is, you look at the big picture and we don't know what's going to happen, but it's hard to imagine something happening that's not going to be good for precious metals.
I agree.
And not good for currencies.
Yeah, and also bringing in, obviously, base metals as well.
Yeah.
Obviously Empress is mainly precious metal, but just widening it. You've got the $1 trillion infrastructure act in the US.
Mm-hmm.
Airports, everything, solar panels, a big green thing happening. You've got now the Defense Production Act that's come in, where they're trying to shift production away from China back into the US.
Yeah.
That is a lot of money, going into the processing metals world. And that makes me very excited.
Yeah.
Just generally for the whole, people go, why mining, why metals? Look at the money that's being moved into, from the US now.
It has to be moved into the US, because the whole onshoring aspect, that's another outgrowth of COVID, where there will not be so much of an economic sensitivity as there was before, because metal prices will be higher and because there'll be a national security aspect to it all. You have automakers looking at lithium mines.
Well, did you see, I think it's Lithium Nevada, whatever, the court case a couple of days ago?
Uh-huh.
They obviously, permitting court case from the local NGOs saying, okay, this should be stopped. Biden came in with his act and said, no, it's going ahead.
Yeah.
So that shows you the positive momentum in the mining space in the US to get that lithium to obviously, generate for those batteries.
Which is interesting
exciting.
because we have not seen as much of that, the government actually coming in reality in favor of mining. And frankly, if they don't, that just means prices are going higher and higher. So the opportunities for investors. So bringing it all together, we're in a mega trend for commodities. We're in a mega trend for monetary metals.
But I totally agree with you, Mum. I don't hear people talking about it though.
Right.
In the investor world.
Not so much yet.
No. And you're going, why not? It's obvious to us. We're in the business.
Yeah.
So maybe that's one of the differences. We're in there. We see, for example, everybody talks about a recession, but base metal prices like copper, it's doing well, $4 a pound.
Yeah.
In a recession, it should be $2 looking forward.
Yeah.
But it's not, because of the fundamentals are so strong. EV, that type of, the production, the shortage of supply that's coming up. So that shows us it doesn't take much on that tipping point to get there, to move as much higher.
And in reality, prices have to be much higher. I think we're going to have $8 copper within 5 years, maybe much shorter.
But
prices
that's
have
partly
to get
because of
higher.
the cost inflation.
Yeah,
thing,
yeah,
isn't it?
and that's going to drive it
copper
even
mine
higher
is
too.
another 30% more on the capex, so you need a better return to do that hurdle, and obviously interest rates, obviously your discount factors going up with your cost of finance, so it's got to be higher.
And because you need copper for everything that they're saying, we have to do, and there's not enough out there, supply constraint. But getting it back to gold and silver, the monetary argument there is that because we can never, because the debt loads are so high, because currencies have to be depreciated over the long term, because at some point the Fed is going to have to acquiesce, and because we most likely will have high inflation because there's not a lot that you can do. They're not going to get it down to 2%. Yeah. All of these factors combine to have you can have high confidence that gold and silver prices are going to be much higher. If you want to play that macro trend, one of the best ways is with royalty and streaming companies, because they are typically much more highly valued in the market, and they have that cash flow, and for a number of other reasons, they're not exposed to the operating risks, et cetera. The issue there is they are highly valued in the market. So where can you find a royalty and streaming company that is, at this point, undervalued based upon every peer measurement and has a steep growth curve? Do you know of any?
Oh, no idea. No idea, Brian. No.
How's that for a silver platter?
Exactly. Thank you very much. So Empress is obviously our royalty company. Is very much, it's only 2 years old. So as a new company, we're now putting our investments, now got 3 producing assets that are producing cash flow. And we're just showing the market we've done what we said we're going to do, which is produce cash flow. And obviously we're driving that through with new opportunities, and we're building the business. And that's where the opportunity comes. That's just at that starter point of the curve. And that's the opportunity for us.
Yeah, that's why I recommended Empress to my readers. That's why I personally invested in the company. It has a lot of interesting factors you don't find in every royalty and streaming company, but the predominant overriding factor right now is valuation. It is not as highly valued in relation to the peers, but the market can only ignore cash flow for so long.
And that's the whole strategy, was cash flow.
Right. Yeah.
Other companies, they go, okay, we're going to do a 10-year exploration play and eventually become a mine.
Yeah.
We weren't that type of company.
Well,
we're just cash flow driven.
The majority of the time, those exploration royalties never generate a cent because the project never goes into production. So, David, great to talk with you today. Thank you so much for giving us the backstory and some good macro talk here as well. It's Empress Royalty and one of our top recommendations in Gold Newsletter. Thank you.
Thank you.